to Rodriguez and Price.
He's Rodriguez, I'm Price.
The show about markets, media, and the unfolding mayhem in the markets and how to navigate it. In the studio, I have the one and only Tim Price.
Hello.
As always, how are you, Tim?
Very good, thanks. How are you, Paul?
Very good. Yeah, so we're in the summer doldrums.
Well, are we? Is it the summer of vol, finally?
It is the summer of vol. It's coming off, isn't it?
I'm hearing people using that expression every day now.
Are you really?
Yeah.
Really?
Dozens of them.
Okay, yeah, dozens, literally. Yeah.
Literally dozens.
It's tweeting it and everything.
Yeah.
Anything interesting on Twitter this week?
I don't know to what extent one should comment about this. There's a guy, well, let's assume we can comment. There's a name, James Chapman, familiar to you?
Yeah, it is, yeah.
So this is one of the more intriguing stories of the last few weeks. So this is someone who's was I think the political columnist for the Daily Mail.
Okay.
And he was reporting to David Davis at the Ministry for exiting the EU. And then over the last few weeks, he's become increasingly, how should one put it, expansive on Twitter.
Oh, right.
And that led some to fear for his state of mind.
Oh, really?
And then yesterday he went off completely, so his complete account was deleted. No, the whole thing went, and then he's come back on again, but he's not tweeting with as much gusto as before. So it's something strange. But what he's reported anyway is the rise of, or the launch of a new party, the Democrats. Right. And the purpose of the Democrats is to overturn the democratic vote that was Brexit. So an interesting name for a new party. Anyhow, there's apparently some March for Europe on the 9th of September. Whether or not he'll be able to attend is another matter.
Oh, goodness me.
But Twitter has been a buzz with Chapman stuff the last week.
Yeah, it's worth mentioning, actually, sterling has been extremely weak, and my call of sterling rising is not working quite so well as I'd expect.
Well, what I can't quite work out from a fundamental perspective is why the euro is so strong, but that's part and parcel. It's the same coin, isn't it?
Very good point.
It's the same coin.
The point is the euro is too strong, and we can see it is starting to turn over against the dollar, so the signs are already there. Sterling is weak, but it's not weak against every currency. It's moving up against some of the commodity currencies, which is a precursor to a move against the euro. Yeah. And it's very painful for holidaymakers at the moment, and business in general, who are suffering from the strong euro, but it will turn around. And I think we've got to be relatively close, although technically it's still in a intermediate downward trend. But I'm looking for signs that it's turning around. So I still think that we will see a massive collapse in the euro as we move into year end. I think the volatility in the equity markets could be a precursor to that. And that's interesting in itself. I don't know if you may not be aware that the crisis started 10 years ago.
No, absolutely. I mean, the papers are me full of it. Yeah. In every sense of the word.
Yeah, and there was an analyst called W.D. Gann who always said that the 10th anniversary of something would see a similar move.
When was that? Because I know the name, but I couldn't tell you when he's from.
20s and 30s, right. Very old technical analyst.
Depression era type stuff.
Rumoured to have made like $50 million when $50 million was a lot of money.
Yeah. But he's big on a 10-year anniversary.
So he was all about numbers and cycles and things like that, and he always said the 10-year anniversary. And I wondered whether it would all fit together so neatly that you'd have the 10-year anniversary coming into August, September when the markets made their first top. Didn't quite hit my Fibonacci target in the S&P at 25.15, I think it was, but I'm willing to take this as the top, given the signs of everything else, as we keep mentioning, Europe is still coming off. But so I think very interesting time. As we've said, do not go away from the screens. You've got to keep an eye on these markets from your beaches, from the holiday, just wherever you are. Just stay tuned, because there's a lot of vol potentially coming. Now, Tim, you've very kindly put some charts together, and they're interesting as always.
So this is a new one. There's a metric that we've been following for pretty much the last 10 years. It's quite technical, but bear with us. So what it is, it's called net foreign assets as a percentage of GDP. And the definition of net foreign assets for any country, it's a measure primarily of determining sovereign creditworthiness.
I think I've seen this in your weekly...
But this is updated. This has been updated by the guys at EFG. So credit to them for updating the figures. So this is as at end June last year, the most recent stats certainly that we've got.
Right.
Net foreign assets is the totality of government sector, corporate sector and household sector assets.
Okay.
Less, I think, foreign owned assets here. But effectively what it shows you is most people, when they're talking about the bond market, talk about debt to GDP. but that's too brute a mechanism. This is far more sophisticated. So to make sense of the chart, what the guys at EFG have done is this is the metric they use for one of their bond funds, or perhaps more than one, but they basically attach a rating between 1 and 7 stars. I think they went on the basis of luxury hotel rankings. So the worst score is a 1, but the best score is a 7. Yeah. So the 7 score countries, and reading those in from the far left of the chart, the likes of Hong Kong, UAE, Qatar, Taiwan, Singapore, Norway, Switzerland, Saudi, they're objectively creditworthy countries. In other words, they have a huge surplus of net foreign assets. Why is net foreign assets significant? It's significant for any country that has foreign borrowings.
Right.
So if you take the example of the UK, Her Majesty's government will never struggle to service her sterling-denominated gilts. So just print more money. Print more money. But I know as a former bond salesman that the UK is also borrowed in dollars. Mm-hmm. We can't print dollars. So the reason why the net foreign assets metric is so important is it shows you really at a glance, A, which are the most objectively creditworthy countries in the world if you come into an environment of basically foreign currency volatility, inability to service foreign debts, which is clearly a real problem. And then not only that, but it also shows you probably it has relevance in terms of currencies too. So all of the countries on the far right of this that are the wrong side of this metric, and reading from the far right in, Greece has already defaulted, Portugal potentially next, Spain, New Zealand, Australia. You can see the problematic countries, and the one that's fallen off is Iceland because they already defaulted years ago, so they've fallen off completely. And what EFG have also done is they've winkled out Venezuela and I think that's Brazil, or possibly Turkey, sorry, because they're not investment grade anyway.
Right.
But so they've been excluded. But otherwise, you can see at a glance, basically.
Oh, Venezuela is.
Yeah, but because it's a year old, but because it's also basically a junk credit, they've taken it out, so it's not valid anyway.
Right.
But for investment grade markets, I think it's an absolutely fascinating roadmap.
Yeah.
A, it shows you where the quality is in sort of credit terms, and B, it's probably a reasonable bet for giving you some kind of roadmap for likely currency appreciation. The countries on the far right of this chart, and many of them are in Western Europe, bluntly, I mean, clearly a lot of them are tied into the Eurozone, so they can't depreciate anyway. But if they did have that luxury, they'd want to do that to remain competitive.
That's spot on. I mean, Greece, I always thought Greece would be the first to leave the euro.
Well, maybe it could still be. It could still be.
But what I like about this is it shows why. So Greece, Portugal, Spain, Greece or Italy, actually, between Greece and Italy.
I mean, Italy's further along, so Italy's not so bad. But the interesting thing here, so you can see where the UK is kind of in the middle, which is not a disaster.
Japan with its GDP.
Japan is a huge surprise on this one.
That is amazing.
So the US, which is on the wrong side of this chart, and it's in worse shape than we are.
That's incredible.
But one of the striking ones is Japan. China also, but particularly Japan. Everyone talks about Japan as if it's some kind of basket case.
Yeah.
Japan Inc., Japan as a country, forget the government because the government's hopelessly indebted, but Japan as a country is hugely wealthy.
Percentage of GDP that Japan is in debt.
It's hundreds and hundreds and hundreds.
It's something like 300% or something.
But it depends how you factor in the off-balance sheet versus the rest.
But that's what I'm saying. The number itself, when you look at the number, you think, how on earth are they able to sell any bonds at all?
But the reality is, there's a lot of money in Japan.
So this
wealthy country.
Explains why, which is.
So I think this is. I mean, we've always found it fascinating, but with the updated figures, I think this is just one of the more interesting charts that's around to analyse credit.
Just so I don't forget, will you be putting this in your weekly newsletter?
Yes, yeah.
So, and how, if someone out there wanted to sign up to your letter?
The easiest thing is probably just to follow me on Twitter @TimFPrime.
And then they'll get a link to your.
Yeah, because I update it every week on Twitter.
Oh, okay. So you just click on the link. Brilliant. Yeah. Okay, fantastic.
So that one I think is a keeper as a chart to try and assess what's going on in the world.
Fantastic.
The next one we've got is taking us to stocks now. So this is courtesy of Grant Williams, things that make you go,
A world of pure imagination.
In his words, I think it's from Charlie and the Chocolate Factory. You can see the dot-com bubble. This is S&P 500, so kind of average price to revenue, slightly different metric.
Chart.
Dot-com bubble is early 2000. Housing bubble is 2006 to 7. And then we know the aftermath. And now, where we are now, it's just off the scale.
So the everything bubble that we discussed
seems to be alive and well.
This is showing us the everything bubble in exactly the same way.
Well, but purely just for, say, large cap US stocks.
Remember, the days of the dot-com boom, those heady days of like that kind of...
At the time, I thought that was going to be a once-in-a-lifetime experience.
Yeah, me too. Really, me too. I thought we're never going to see this again. Because prior to that, I used to teach people about bubbles, and I'd have to get out a book called the Madness... No, the...
Delusions and the Madness of
Crowds.
Yeah,
that's right.
Like that.
The Extraordinary Delusions and the Madness of Crowds by Edward Mackey, I think it is. And people just didn't understand what a bubble was. They were like, okay, there was a crash in 87 and 29, but there was nothing really to show. And then we've had bubble after bubble after bubble as evidence of what bubbles
.com begets property, property begets everything.
And now we've got Bitcoin. People won't see it as a bubble, but it is. It's definitely a bubble. So you could only have a bubble in Bitcoin. Why would you buy something?
Well, you can have a bubble in pretty much anything if interest rates are at zero.
You can have a bubble in anything. We've had bubbles in everything pretty much. We've had it in gold. Well, I think so. We've had it in oil. We've had it in wheat at one point. We've had it in equities, property market. So there's all sorts of bubbles. But this is fascinating. This shows us the extent of where we are as opposed to it just being a bubble. Because, of course, you never know how far the bubble can go.
Well, I had a great definition of a bubble, which is a market that becomes just outrageously priced and then doubles.
Yeah, excellent. Right, so what have we got?
More of the same on the next chart. So the next chart is, this is actually, I think one of the best ways to assess the relative value of gold is as a ratio. Because gold doesn't pay you a dividend, doesn't give you a coupon. So I
prefer it to Bitcoin, though.
Oh, no, for sure. No, me too. I mean, the thing is about gold is you could argue it's been in a 5,000-year-old bubble, but it's been money good for 5,000 years. And it exists it's tangible, fungible, et cetera, et cetera, et cetera. Bitcoin, as far as I'm concerned, is a digital creation. It may or may not have, it has the value people will attach to it, but gold you can store and keep it outside the financial system. Bitcoin is intrinsically part of the financial system by dint of being digital. So I'd just rather have the physical asset over a virtual one.
I'm going to bring in some of my technical analysis rulers and there's a limited supply of them. So we'll give some of them away.
By now, while stocks last.
I'll bring some in and we'll give some of them away to you guys out there.
I sense a quiz is
there will be a quiz or something we'll think up.
But this is gold versus the S&P. Quite straightforward.
Gold versus technical analysis rulers. Which you
so to read, this is from, again, the guys at Real Vision. So over the past 40 years, the S&P 500 and the gold price have traded on basically both sides of this sort of ratio, gold divided by the S&P. And as you can see, 1980 was the last top, or the last but one top in gold, and then we've come all the way down to 2000 when it was cheap, and Bunker tried to corner the silver market. Then you got the 2000 era, basically great, or 2000 millennium turning point. Gold was with hindsight, a great investment. We were back up, and we're all the way back down again. If history is any guide, this is probably if you were going to be a pairs trader, going long gold, short S&P 500 has to be a standout trade.
Well, there's some very smart people among yourselves who is saying that gold is a buy here. Jim Mellon's one, and I think it's worth thinking about what might happen if we are seeing the beginning of the end of, say, the euro. So if we're moving into a volatile period in stocks, which will ultimately unravel the equity market. Sorry, the currency market. That's when stocks go down, it put pressure on the euro. That's where like you were saying, with Greece, they can't devalue their currency, so then the pressure.
So ultimately, the only realistic choice is to walk away.
Yeah, and
then come back to the new drachma or something.
So pretty much that pressure we'll start to see it in the equity market, which will then go into the currency market, and then people will be looking for a risk hedge. They may have already priced Bitcoin to perfection. What's left? There's gold. So I'm not a long-term bull of gold, but I think this is an important period to be wary of a move up. And this chart is fantastic. I mean, that's really, really excellent. You can see that we are heading towards a very important low point. And if this correlation does follow, then it's an excellent risk-reward trade. So I think, good chart to pull out.
We've got a lot, and that's via the guys at Real Vision. The last chart we've got is via the guys at Incrementum, who are based in Liechtenstein, and they're Austrian school investors. Yeah. And this one is, I just find intriguing more than anything else, market cap of the entire MSCI World Metals and Mining Index versus Google. Now, I'm not saying here that Google is a bubble. I'm not saying that Google is overpriced. So perhaps it is.
I think it is.
But I think
you're not making that as a primary
that's not my point.
What
the point I'm making is just look how cheap gold stocks are, how mining stocks are, basically real assets versus virtual ones.
Yeah.
So in other words, for the market cap of Google, you can own basically every miner in the world.
That's incredible. And I have to say, as brilliant, as amazing as these technology companies are, there is an upper limit to how much they can grow and how many, with Apple, with how many iPhones people will want to buy and the specifications for these things.
But for my money, I wouldn't be betting against Google. I'd probably prefer to be betting against Amazon as a stock, because I think Amazon's gone into completely untenable territory.
That's a brilliant call on Amazon, because it's spiked into a new high and it's come back and it's making a classic reversal pattern. It's really key. So guys, check out the Amazon chart if you get a chance. Looks like a massive head and shoulders reversal. Again, just to quote Jim Mellon, he's come out with something that I've had a view for ages, and that is that Google, I think, or Alphabet, will eventually be government owned. I've always thought that, because they're just so powerful. They've kind of got more data and more influence, if you like, than perhaps the government itself. So what do you do with that data? As long as the people there will use it for good, you've got a good situation. But it's possibly too valuable what they've created for it to stay.
It's a really intriguing prospect.
It's an interesting situation. We'll have to see how it develops. But I think we're just about out of time. But just before I watched your recommendation from last week, 2 weeks ago, which was the Dunkirk film.
All right.
Absolutely
Christopher
awesome.
Nolan.
Absolutely awesome. Take my hat off to him. Done a brilliant job. I don't think you're going to see a better film this year, really, are you? I mean,
the cover of Private Eye magazine did a good spoof of it, because they had all the soldiers cowering out on that sort of beachhead and waiting for the sort of Stukas to start their attack. And the little speech bubble was, turns out it's more difficult to leave Europe than we thought.
Excellent. Excellent. Well, on that note, enjoy your holiday. Keep an eye on the markets. We'll be here again, and I'll bring those rulers and there'll be a competition. Thanks for watching.